Welcome back. For now, the SGX Nifty is indicating a start in the red, so down about 40 odd points. It's been all over the place this morning, but now at the low point of trade. Anuj joins in for a quick trade setup. Anuj, hi, morning. So near, but yet so far, right?
Yeah, it is. But, on days like today, you normally take a simple trade. You buy and put the SGX Nifty low as stop loss, and that trade normally works. I think this whole Russia-NATO thing perhaps is a bit of a more than just spoiling the mood. It's just an excuse to take profit and to get fresh entry for people. I think that's my sense. And the SGX Nifty could actually be a bit of a wrong indicator today because the market's momentum is very strong. And normally you buy in geopolitical tensions, especially if you are in a bull market. That's been the trend over the last many years or so. But the only other thing which might sort of be an important factor going forward, Sonia, is what's happening in China. Because this month, Hang Seng is up 25%. From October 31 to now, 25%. Now, why is that important? Because ETFs normally chase momentum, and momentum was clearly with the Indian market. Now the momentum is with Chinese market. So do we see slackening of funds and momentum and funds going to Chinese market? I think that's something that I'll keep an eye on. But the US data overnight has reaffirmed the biggest positive for the market, which is slowdown of inflation. So I think overall the cues are positive. On the Nifty, the strategy is clearly buy on dips. Chasing rallies is not a good idea. So 18,225 to 18,300, again, if the market gives you that zone, this is the zone we discussed yesterday, and the market reversed from here, or 18,025 to 18,100 if you are a safe sort of player. And the all-time high of 18,600 is where the algo traders will book profit. So that could be a bit of a worry factor. HDFC twins have been very strong. I think on the bank Nifty, perhaps today could be a day to avoid because yesterday we had all-time high closing, and going by the options data, it looks like maybe there's some volatility now at all-time highs. But if the global market stabilize, maybe the bank Nifty leads it once again. But clearly, Nifty looking very strong, courtesy the HDFC twins.
Okay, all right. Thanks a lot for that, Anuj. Indeed, data points looking extremely strong. Well, let's get some F&O trading strategies then. Rajesh Palvia, the Vice President, Technical and Derivative Research Analyst at Axis Securities, joins in. Hi, Rajesh. Morning. Thanks so much for joining in. What do you have for us today in terms of strategies?
Morning, Nigel. So we have three buy stocks at this moment, and looking at the setup, we feel that buy and dip should be the strategy, and we feel that momentum is likely to continue further on the higher side. So both the indices are looking positive. So first stock is from the cement space. Cement space has done well in the previous trading session. So from that space, we like Ultratech Cement. Stock is now approaching to its multiple resistance zone. Looking at the setup, we feel that Ultratech Cement can be a buy. With a stop loss of 6930, upside target we are projecting 7140. Another stock is from auto ancillary, that is from tire space. So Apollo Tire is another buy. Looking at the setup, now stock is approaching to its swing high of 2018. So it's a multi-month breakout we are witnessing on the Apollo Tire. So looking at the breakout, we feel that Apollo Tire can scale up further higher towards 315. One can keep the stop loss of 292 to buy Apollo Tire. Third one is from hospital, that is Apollo Hospital is another buy. Strong breakout on the chart, strong open interest addition we have seen in the last couple of trading sessions. So looking at the setup, we feel that Apollo Hospital can scale up further higher towards 4750, 4800. One can buy with stop loss of 4540.
Oh.
All right, so individual trades. Thanks very much, Rajesh. Appreciate you joining in with some of that perspective. So that is the view coming in on the futures and options side. Let's just take a look at the pre-open rates which are coming through. The rupee, by the way, is also opened sharply lower. I mean, 81.39 as compared to 81.1 to the dollar. And that's a 0.5%, almost a 0.5% lower start on the dollar, on the rupee. So the dollar is higher by that much this morning. I mean, the trade deficit numbers came through yesterday during market hours, and they painted a sober picture. Export growth is kind of slowing. Imports, of course, remain steady because the economy is doing well, but the world is slowing. So, it's showing up in the rupee. By the way, day before yesterday, we saw a very sharp fall, yesterday it was stable, and today, once again, we've got a bit of a dip, which is coming through. Deven is with us on sort of specific stocks and market fundamentals. Deven, take a pick. I mean, Fluorochem saw a big sell-off yesterday. It's come off quite sharply. I think the high was about 32, 33, Actually, 4,000 plus, right? At about 3,400 now. Aster DM, which has done well recently, it pulled back sharply yesterday. And a Globus Spirits. Any of these names if you track or have a view?
No, Prashant, in general, I think we believe that the companies which are there in the specialty chemical business, I think who is basically having the advantage of having the CRAMS model and API supplies, I would probably think that they're relatively better off in a situation like this. Obviously, the last quarter probably in the space has gone, a little bit more volatile because of the raw material related issues. But now that part seems to be sorted out as most of the companies are confirming. So in my viewpoint, I think some of the specialty chemical names, not the ones which you have mentioned, maybe I think the other ones which we like, are relatively more clear. The likes of Anupam, where things are a little bit more steadier, even for that matter, Ami Organics, that things are looking more steadier than before. So I think such kind of companies probably we feel are relatively better off in the environment like this, while fluctuation in the raw material prices probably has hurt them in the last quarter. Comparatively, they would be better off in the next 2 quarters. That is how I see.
Okay, Deven, appreciate your thoughts. Thanks a lot for joining in. So the quick comment on the market is that as of now, market is down about 75 odd points. The rupee has weakened a tad bit in early morning trade. 81.30 is where I saw the rupee last, so just keep an eye out on that. 81.40 almost now. And in terms of individual stocks, it's BEL that's topping the charts after signing those agreements, multiple MOUs for military-grade components. So BEL is up 2.5%. RVNL is doing pretty well. Apollo Tyres is well in the green after positive commentary and the 20% growth guidance from the management. Exide is moving higher as well, and a couple of other names looking pretty good, like Union Bank. But Hindware Home Innovation is the other stock that we're looking at. Steady set of Q2 numbers in what was a seasonally weak quarter. A revenue growth of 16%, but the margins dipped on account of higher costs. Similar story across the board. Sandeep Sikka, who's the Group CFO at Hindware Home Innovation, joins us now. Sandeep, morning and thanks for joining in. Can you tell us how the demand environment is right now? Because costs are inching up higher, but then demand is also coming back. Is there this double-digit growth, high teens growth? Is it something that you can continue in the second half of the year?
We are fairly confident that we'll continue with the double-digit growth in line with the guidance we have given. Over the last 6 months, we have seen the demand fluctuation, like especially the demand in the festive season was not that great, and but it's in the off late. In the last 3 weeks, we are seeing that the demand is again coming back. So we are fairly confident that the guidance which we are given to the market in terms of the growth, the momentum of that we should be able to continue. Right now, the whole market is suffering the input high price volatilities, like on the plastic side, PVC side in the business, the prices have come down. On the other side, the gases prices have gone up. So margins protection will happen, but the growth number we are fairly confident.
Okay, all right. Hi, Mr. Sikka. Good morning. Earlier, you were guiding for 18 to 20%, right, in terms of growth. Do you stick to that for the year, for FY23? And give us some margin breakup. If you want to give us segmental, what is the guidance from year on? Because some of those input costs have started cooling off. So my guess is that margins could improve. Do you concur? And if yes, what should the guidance be?
Right now, if you see the margins which we have right now in terms of EBITDA margins, they have a delta of around 4.5%, which are relating to the input prices impact. And we feel on a consolidated basis, our margin trajectory should be in a range of 14 to 16%. These are EBITDA margins, which I'm talking of. And definitely on that 18 to 20% growth, as I said, we are confident we should be able to maintain that momentum going forward.
Just a word on the margins, sir. For the last quarter, your margins are in single digits.
Yes, I know, because if you see the impact of that is due to the input prices, like on the plastic PVC side, the input prices came down drastically. And in the last quarter itself, we had mark-to-market losses on the inventory ranging around 19 to 20 crores. So if you add that up, the normalized margins should get, ranging 14 to 16% that I'm talking of.
Sandeep, hi, good morning. So this 4 to 4.5% delta that you're talking about, right? That's big. Can't that be sort of bridged with price increases?
So if you see, right now the prices will normalize over a period of time. Like I think another quarter 3 will be a quarter with an impact. But we feel the quarter four, the margins should get normalized, and the input losses on the plastic PVC business, plastic pipes business, which we do. So that will get normalized, and accordingly, we feel that on overall trajectory that delta will get normalized. So what I'm talking here, that 4% is a normalized. I'm not talking of a specific for the year.
Is this largely because of the pipes segment? I mean, this big margin problem? On sanitary ware, faucets, are things much better?
The main sufferer is the plastic pipe business, or 25 crores in the first half is on the inventory losses. Due to the certain drop in the prices. And even on the sanitary ware side, the input gas prices increased drastically over the last 6 months. So another 10 to 12 crores is on account of that. So if you add it up, you will get the number of what I'm talking about.
Okay, and I wanted to have some thoughts on the appliance business. Currently, you're doing about 125, 130 crores per quarter. The last time you had said that you're looking at 1,000 crores from this business. So where are you at in terms of market share, and what could the growth trajectory look like?
So market has been slightly dismal here, although our numbers are much better than what we are doing, when you see the overall industry trends. We lost a little bit of market on the fans, which we launched last year. But this is something, we are number 2 player on kitchen chimneys today, and with almost 4-5 years of business. And going forward, we feel that we should be able to catch up 1,000 crore, because this guidance was given last year and it was ranging in 3 to 4 years time. So we'll catch it up.
By 2025, you think you'll be at this 1,000 crore mark?
We should be.
Okay, and final question then on your debt front. It's gone up a little bit. What is the consolidated debt right now? And given your ambitious plans, do you see it trending higher, or do you expect it to cool down from here?
So the consolidated debt is odd around 850 crores. But this primarily the debt has been acquired when we did acquisition of the manufacturing of sanitary ware faucets and pipe plants in March 2022. We feel that with the profits coming through and the surplus cash flows which will accrue to us in the next 2 to 3 years, major chunk of this debt we should be able to pay off.
How much?
Ranging between 200 and 250 crores in next 2 years, and then I think and every year thereof we will have to pay off.
Okay, appreciate all the numbers that you've given us and your thoughts on the business as well. All the best. That's Hindware Home. But just counting down to the opening rate, the pre-opening has settled absolutely quiet. So it looks like this market is not giving up on its bullish hue just yet. Nifty is at 18,400. A lot of stocks are moving around quite well. The leaders of the pack clearly have been banks, and this morning as well, looks like some of them, Kotak Mahindra Bank, will lead from the front. There's Adani Ports that's moving up quite a bit. In fact, this month, the Adani Group stocks have come back, and how? Adani Enterprises is up 21% this month. Adani Ports is up about 11%. So let's go across to Sudarshan. Sudarshan, before I get your 9-10 call, any thoughts on these Adani stocks? Do you think there's more traction technically here?
There's more traction in Adani Ports. For the others, I can't say. But I think Adani Ports is a buy on dips opportunity. The Nifty itself is a buy. I told you that stops should be 18,280 or close by. And Muthoot Finance is a buy with a stop under 1,075.
Okay, all right. Thanks, Sudarshan, for that. Mitesh, what about you?
Yeah. I'll go with the buy call as well. United Spirits, that's a buy with a stop on 890 for targets of 940.
Okay, all right. Thanks, Mitesh and Sudarshan, for that. Just counting down to the opening for the market, Escorts is one stock that could perhaps see some bit of a green tick today. Remember, the stock was under a lot of pressure after the earnings came out and the margins were thrashed this time around. But the company has said that effective today, they're going to hike prices in their farm equipment space, especially for tractors, and that will be in order to offset the cost inflation across commodities and other costs. The quantum of price hikes is not known, but remember, the material costs for the company have gone up substantially in the last quarter, so they have to do this in order to sort of pass on material costs. The margins were down almost 200 basis points quarter on quarter, so it's been a tough ride for them. And they are looking to get back to double-digit margins, so these price hikes perhaps will be imperative for that. But PB Fintech is the other stock that we're tracking this morning. Surbhi is here to tell us why. Surbhi.
CLSA initiates coverage on PB Fintech with a target price of 600 rupees, which is close to a 50% upside from its current market price. They say that the insurance industry is expected to grow at a 10% CAGR over the next 15 years, and PB Fintech will be a key beneficiary. According to them, the modes of PB Fintech include a robust customer funnel, a high share of direct customer traffic, and strong underwriting to insurers. The company has a take rate of nearly 15% for its insurance business, and they expect the core revenues to grow at a 37% CAGR in the next 5 years, which will be driven by similar growth in industry premiums. They expect that the company will achieve break-even levels by the second half of FY24 and PBT of 600 crores by FY26.
All right, thanks for that. Well, Apollo Tyres is the other one that we're looking at this morning. Remember, it was up almost 5% yesterday, and a lot of positive brokerage views coming in. Citi has a buy call. They've raised their target price to 340 on the stock. You have Morgan Stanley that has an overweight call. They have a target price of 329, and Nomura, they've downgraded it, but they still have a neutral with a target price of 327. Now, the reason why most brokerages are bullish is because Apollo Tyres has given a revenue growth guidance of 20% for the standalone entity. They're saying the India business is doing very well, led by a pickup in the commercial vehicle replacement demand and sustained growth from the OEM replacement segment. They've also taken a 5% price hike in the India business and a 5 to 12% price hike in the truck and bus radial segment in Europe as well. The only problem for Apollo has been rising debt, and that's put a lid on the stock as well. The debt now stands at 5,500 crores. But just counting down to the opening for the market, it's the Adani Group stocks that could take it from the front. Adani Ports up about almost 1%. And then you have Coal India, Wipro, HCL Tech. There are 2 new listings as well, so don't lose sight of that. BKG Foods expected to be a moderately positive listing. And Medanta, which is Global Health, will be listing today. It's a big one, 2,200 crore IPO, and 500 crore will come straight to the company for that is Medanta. So we'll keep an eye out on these stocks. There you go. That's the first tick on the index. Quiet but positive. So that green hue continues. ICICI Bank from the frontliners is making sure that the Nifty stays above 18,400, followed by ITC, which is up about 0.2%. The technology names are coming back a bit. So Wipro, Infosys, HCL Tech, TCS are all in the green this morning. And then you have a couple of pharma names as well. There's Cipla, which is trending in the green, up about 0.5%. Coal India is coming back a bit, so up about 0.7% there. And then you have two-wheeler names, Eicher, Bajaj Auto, there's Maruti Suzuki that are all looking pretty good this morning. Titan as well from the consumption piece. Those loads of weddings that are going to take place over the next couple of months. Titan, big beneficiary of that. On the downside, you have Apollo Hospitals, HUL, Bharti Airtel, Nestle and Hindalco, a couple of these names that are under a bit of pressure. In fact, if you're looking out for a sectoral trend, it is FMCG. So there's Nestle, there's Tata Consumer, Britannia and HUL that are all in the red, and Asian Paints as well. So FMCG has taken a bit of a backseat this morning. But other than that, it's a very, very quiet opening, just consolidating around this 18,400 mark. There's better action in the mid-caps.
Well, that's right, Sonia. Plenty of action out there, and good to see that that one's doing an outperformance after doing an underperformance the last couple of days. BEL on that order win, that's up close to around 2%. PI Industries continues its uptrend. It's 1.5% higher. TVS Motors as well eking out some gains. From the frontline pack and the F&O stocks, you have Polycab that's come in for some mild profit taking, and even Metropolis, well, that one is a little bit lower. But as you said, from the broader markets, well, it seems these railway stocks, they continue their uptrend. You have RVNL that's moved up. IRCON as well is higher in trade. You have RailTel that's higher in today's trading session. And a couple of other names as well that are moving higher on volumes is Hoodco. Well, that stock has moved up. You had that upgrade coming in on PB Fintech, and that one's up close to around 1.5%. TCNS, I saw the initial tick was in the green. Those reports indicating that maybe the company is on the block. So that one moves up. But Nykaa, yesterday you saw a fair bit of action in terms of large trades that took place. And that one, in fact, is down close to around 6%. As our ticker read, it's close to around 1% of large trades that have changed hands. So interesting to see the parties out there. What else?
So that's on Nykaa, right? A couple of stocks, despite the flat move in the market, a couple of stocks hitting fresh 52-week highs this morning. The PSU Bank rally is not over just yet. 1% higher on Union Bank, and it's a fresh 52-week high. I don't know the last time I saw Union Bank up 50% in a year, and this is that year for PSU banks, right? And then you have RVNL, There's Railtel, all at fresh highs. There is Mazgaon Dock, more on that in a bit. Mazgaon Dock is at a fresh 52-week high, and what a rally it's been. If you can get a one-year chart of Mazgaon Dock, it's up 200% this year. And now standing at 850 rupees. The market cap of Mazgaon Dock has also risen substantially. It's now almost a 20,000 crore market cap company. So, this entire space has been rallying and rallying hard. So these are some stocks that we're looking at on the upside. More 52-week highs coming in for names like Cummins. There's, something like a TVS, Sri Chakra. These are small names that are sitting at fresh 52-week highs, but that's the chart of Mazgaon Dock, looking pretty good. For the headline index, though, it's just sort of buying time around these levels. The pressure today is coming in from some of these FMCG names, as I said earlier. Nestle, HUL, Tata Consumer topping the list on the downside. And then the Bajaj twins, Bajaj Finance and Finserv, are down about 0.5%. Otherwise, you'd have to say very, very quiet, not too much. Towards the end of the year, this is what happens, right? I mean, people don't want to take aggressive bets. They are perhaps going on holiday. There's the Christmas, Thanksgiving break that you have in the US. So people taking their time off, and then market goes sort of going into a limbo.
Always happens, Sonia. I mean, the institutional kind of imperative, right? You don't want to mess things up. You've had a good run. Don't do anything brave or stupid, more importantly, into the end of the year. I mean, for individual investors, and it doesn't matter, but in the institutional world, it's a real thing. And that's something which we've seen year after year after year. It is absolutely flat. I mean, you've got the mid-cap index, which is up a little bit, small-cap index, which is faring okay, but the Nifty and the Sensex are not doing very much. It's a reverse of what we saw, the kind of market we saw into close yesterday. Just a couple of other names, if we are able to pull this up. I mean, as we start, there is, I think, about a 20-point cut. Okay. What else in the broader space? Maybe Nykaa, if you can put up. It saw a large cut yesterday. I think those bonus shares are tradable now. And Nykaa is down another 4.5% at this point in time. So that's a large cut with large volumes as well, 182, 183. Paytm is down about 2%. So that is at about 613. Policy Bazaar, of course, I mean, Vahishta, I think, put out that call from CLSA. They like the name. And Policy Bazaar is starting 0.5% higher, but I mean, more or less flat. DCM Shriram is coming up with some sharp cuts. If you can have that up, 6% lower on DCM Shriram, 836. Max Healthcare is coming up with, a 1.5% cut. There is Motherson Sumi, if you can have that up. Am I seeing the price correctly? I don't know, Sonia, if there's any news. I'm seeing an 18-19% cut. Or am I looking at the wrong names? This is the 68, 67, 68 rupee one.
Okay, so wiring, Samuel.
That's a 14% move higher that we're seeing. Okay.
There's a bonus issue actually that is effective today.
Yeah.
2:5.
So that is what it,
yeah. So that's, I think,
it's adjusting for that.
Yeah, adjusting for that.
Polycab is another one which is down about 1.5%, which is coming through at this point in time. So that's the market for you. Not very much, at least in terms of the overall indices, but for the last so many days, it has been about broader stocks, broader markets. Ajay Srivastava is CEO, Dimensions Corporate Finance Services, and he's with us to take some questions on markets. Ajay, great to have you with us here on the program. It's always a pleasure. Your views near to medium-term markets, we are practically at new highs, all-time highs. So very close to reclaiming those. But what after, in your opinion, Ajay?
Prashant, my sincere advice to everybody would be, if markets are good high, this is a good time to take money off the table and go spend it on yourself. Investing in this market at these prices, valuations, you could be in for a big disappointment compared to many other sectors you want to invest. So if you want to invest, perhaps, I would not recommend equity. Strange coming from me, at this point of time, equity investment. Look at a 12-month horizon. You will never make returns to beat the debt returns at this point of time. You'll never make it. So you have two choices. Either you invest now and repent later, sell now, spend it on yourself and feel happy, or put in debt and you'll be a much happier person.
Spend it on yourself. I picked that option. Investments can continue through your life, right? I mean, Christmas doesn't come. It comes only once a year.
Absolutely. I don't know why this Indian thing of saving money. They just need to spend. We as a country need to spend more money. Can't you see people are not spending money anymore?
Ajay, I just look at one article on how many weddings there are in the next 5 months and how people are spending, and you'll change your view on Indians not spending. I mean, the amount of weddings and the spending in the last, it hasn't happened, I think, in the last 3 years. And that also brings up another point about consumption, right?
Yeah, as I said, there's a 5% of India which you see actually. You only see 5% of India. That's a good part, and I think it's a good relevant India for you to see. That's booming. Absolutely, they are consuming. They are spending in the higher end of the income bracket. There's no Sonia. There is no problem on that end. The top 5% have no problem at all. I think it's a bottom 70-80% which has got a serious problem. And that's why there could be possibly a dichotomy between how the economy does and how the stock market does. You can say it's irrational, it's boom, whatever it is, but that's what it is. Reality is that the 5% or 10% of India that you spoke about, the marriages, the extravagant marriages we see in Delhi and all over the country, absolutely correct. They are spending money. But 85% of India is not able to spend money. And now, how long can the dichotomy continue? It can continue for years to come. But markets have shown, if you look at last 1 year, you would not have made any money in the market if you stayed for 1 year and a long term. Your index is 1% or thereabout. Your banking index is about 9% or thereabout. The best one is, of course, PSU Bank Index, which very few invest in at this point of time. Pharma is down, IT is down. So, so if you look at point-to-point comparisons, market does reflect Indian reality of slowing consumption and the slowing economy at this point of time. It has not given returns over the 1 year period. We can well say US did worse, which it's supposed to do worse. But they elected a government which was ridiculous government, and they still continue with it. House at least is gone. But if they don't change the political dynamics, they can drag the world down. And we have seen that. We can say we are an outlier, we are sitting in an outpost, but the fact remains we will be linked to America. If America does not change its president's next 2 years, your returns are going to be very mediocre. Americans have got a shellacking on 401k case, which is a savings account. You will not perform better than Americans. If Americans don't pull their act, it's very difficult for any equity market to perform.
Sorry, just to come back on that point that you began with, Ajay, this is a great time to lock in these yields on fixed instruments, fixed rate instruments. Could you press on that point, explain that?
See, even at the lowest level, which you see, for instance, Power Grid, etc., the REITs, which are the integrated REITs, they give you 9.3% return at this point of time. Post-tax, they give you something about, part of it comes pre-tax, about 10%. I don't think your index is going to give you 10% if that's what you're looking for in a 1 year period. Your debentures are now at 11.5% or thereabouts that you get it. Even the 6-month treasury bill you can buy on the RBI portal is about 7.5% at this point of time. So, if you look at that perspective, today, locking in debt yields in instrument is a remarkably good idea. Worst case scenario is your EPF and PPF. They give you an 8.1% yield tax-free at this point of time, which corresponds to about 10% return on an absolutely 100% safety basis. Markets cannot do better than that in the time frame that we are in at this point of time. Let me assure you, the next 1 year, we've already seen the result this quarter, not the most flattering results. Let's see how exports go on for the next 1 month or so. Is it 1 month seasonality? And therefore, what you see is slowing consumption. Indian economy is going to grow at 4%. If economy grows at 4%, nowhere market will grow at 12%.
Hi, Ajay. Morning. Let's talk about a couple of other stocks, that we have spoken about in the past. I recall a couple of months ago, you joined us. You were saying Infy, I think, is providing a good entry point. And tech actually has done pretty well, in the last 2 months. So what's the view on the tech space? Do you believe that bulk of the pain is in the price? Or given that we're expected to see a slowdown, well, there could be plenty of pain in store.
I don't, sure, there can be pain. But I think this is one sector when it goes to historical lows, 52-week lows, it's a must buy because you'll get good returns out of this sector. Unlike any other, you can have a demand compression for a quarter or so, but you can't change the dynamics. You can't create an Infosys. You can't create TCS in the world. Between Accenture, TCS, and 4 Indian companies, they divide literally the world of software. You can't make a company like this. You can certainly create a new cement company. You can certainly create a new EV company. You see what happened in EV space? They massacred the existing players. Bajaj Autos and the Hero Honda, they're nowhere in the space. Suddenly people from outside come in. But people from outside cannot come in the software space. These companies will rule the roost. The trick is, do not buy on the highs because you repent it. Like in the market, you repent buying the highs. Wait patiently. There is no hurry. You will get chances. You got chance 1 month back in IT. Even today, it's a good price. I would say most IT stocks. You'll get good dividends, reinvest them back if the price is lower. but be consistent with IT. IT is not about buying for 3 months. IT is about buying for 3 to 5 years. And I promise you will give a much better return. IT is one of the best return sectors if you look at Indian for a 5-year perspective. Almost 22-25% return, inclusive of dividends. No other sector in India has given a 5-year return of 25% consistent in India. So I would still say next 5 years, bet on IT, you will get again the same returns.
Okay, and what about ITC? That big boy surprised everyone. You were bullish on it the last time we chatted. Running out of smoke, or there's plenty of steam in store?
Well, it all depends upon people like you. Keep goading him. Keep goading him, and it's going to result. It's like the reluctant bullock, which moves suddenly, then you get a return, then it stops again. Now you channels can put some little more pressure saying, guys, where is this segregation of hotel business? Where is segregation of tech business? Come on, put some pressure, guys, and investors will rebel. I think it's an amazing case of phenomenal value going waste, if you ask me. And I think we just need to be pressurized to do something. I want to go into the brain of the CEO of ITC and say, what part of this you don't understand, man? Just listen to some of the people. Sonia, you have been a cheerleader for ITC. You can follow the suit and tell him, listen, guys, just do it now and put us out of our agony before we retire.
If we had that kind of power, I assure you we wouldn't be sitting here.
We're putting pressure. Ajay, I assure you we're putting pressure, but hopefully he listens to that. And I got a little nervous when you said it's on people like you. I was like, I'm not a non-smoker most of the time. So I was like, Bob's watching, what's going on?
No, but I mean, I take your point, right? ITC was like a big meme fest, and then look at the way the stock has zoomed. Where else, Ajay? Where do you see the next move coming from? If you perhaps had owned names like ITC and M&M, you would have been, perhaps flying to the Bahamas this year. What will make you do that next year?
I think, my view, we continue to be very strong on the mining sector. In the correction, we picked up a lot more stock, and it's done reasonably well at this point of time. I think mining will remain a good stellar for India perspective. It's done pretty okay in this year, not so bad compared to with dividends and capital gain put together. You got a yield of about 18%, which is okay. I think mining will continue to be. Power sector, I think, should give phenomenally better returns as India realizes that you need to pay for power, both broadly speaking, at the end of the day. So I think between this and power sector, some of the capital goods companies, which are the good ones, which are the execution companies, like things like, I'm not saying recommending a name, just giving example, things like CG Power, they have done phenomenally well at this point of time. I think the execution companies in the capital goods sector, they would do, I think, well. You could have a very beautiful case of a L&T restructuring. They're already doing some mergers, etc., etc. Now, if they split the company, this company is worth 3 times what it is today. If they just get rid of their finance company for awful reasons, what reason they kept it, I do not know. Learn from GE. It can take you down, buddy. Take finance out. L&T is a brilliant company with a phenomenal valuation. So I think if this restructuring story plays out, you've seen UPL, agrochemical story, and now we got holding in that. So it's not recommending, but I'm saying it. Look at the restructuring story playing out. On a global level, they're restructuring. So I think there are sectors, restructuring stories, which are coming into play in India, which has given very good returns in the past, will continue to give returns. So I think players like L&T, players like UPL, etc., which are restructuring the basic operation, very good. Government defense, you can invest, and they have done phenomenally well. We have been saying that. But invest with the peril that they can be the same way, they can go the same way as an IOC or BPCL. It's a government diktat to say, you make 7.5%, 12% return. Tomorrow they say they make too much money. Let's increase the defense expenditure, reduce the profits of Bharat Dynamics or Bharat Electronics, etc. Well, you can do nothing about it. So I think it's a high risk, but a reasonable venture to be if you want to put your money.
Okay. I mean, and we have the management of Mazgaon Dock joining us a little later, Ajay, so you might want to hear in. Just one last point. All these Nykas and Paytms and policy bazaars of the world, as Zomato, for example, anything coming to delivery, another one. Anything looking interesting to you?
Interesting to sell if you have. Prashant, they have made the biggest fool of investors. The employees and PE funds have made the biggest fool of investors in the history of investing. They give a concept called adjusted EBITDA. They give a concept saying, ESOP, which we sell in the market, we get for 10 and such. That's not a cost. You know what? That's not a cost. Ignore it. Ignore it. I think they are the biggest. I think it's a tulip mania in a different world altogether. They don't make any money, they lose money, and they still got value. They sell for 200 crores, they make a 200 crore loss, does it need to be a genius to do that kind of stuff? Man, I tell you, I can find 100 other people who can sell for 200 and make a loss for 200. Ask the airlines, they do it very well, actually. So, I would say just stay away for the time being. These are overhyped, overvalued. They still haven't gone down to Earth. And Earth is still far from them. They're still not there close to it.
Not mincing your words, Ajay, this morning. Thanks so much for stopping by.
Thank you very much.
On a whole host of sectors, giving us your view on the markets as well. Always good chatting up with you. For the time being, though, let's focus on the cement space. And we have Mr. Rajneesh Kapoor, the COO at JK Cement, who joins us. Hi, Mr. Kapoor. Well, the last quarter was a bit of a dampener for all cement companies. For y'all as well. Though I recall when you joined in September, you said that things were far bleaker. It appears that you surprised the street positively, which is good news. But we want to talk about what's the way ahead from here on. I've been hearing some price increase that have been taken up in the last couple of weeks. Could you quantify what is the price increase that has been taken in the regions that you operate, point number one? And you're also guiding for around a 10% volume growth for the year. That would mean around 8% for the second half of the year. Is that correct?
Yeah, that's right. So in terms of price increase, October, we did see, despite there being a very substantial drop in volume on a year-on-year basis in October, because of this year, October had Diwali and Dussehra festival falling together, which was not there in the last year. And so while the volumes did go down, but since I think all the industries, all the players were absolutely, struggling to keep afloat in terms, some of the companies were just struggling to keep afloat in terms of positive EBITDA, so price increase did happen. It was primarily led by South and East, where we saw a price increase of about 7 to 8%. We operate in South India, so we did get some benefit of that. West also saw some price increase of 2 to 2.5%, and our little operations in West gave us benefit there. However, North and Central were almost flat to negative in the month of October. And where our major operations in North and Central, where our new plants are coming up, are also there. When I say that, one has to keep this point in mind that North was already on a slightly higher level as compared to the other places, South being the highest in in terms of price across all the regions, but North was also pretty well, and East and all were catching up because last year they had a pretty low price in these quarters. November initial price trends are good. We see a 5 to 10% price increase in different regions. West sees about 4%, South and East also in 3 to 4% region. North and Central, unfortunately, are at this point of time flat. There was an attempt
Mr. Kapoor,
of trying to increase.
Mr. Kapoor?
Yeah,
let me come in. So you're saying that the initial trends are positive for November, and you're expecting on a blended basis, say 5 to 10% price increase is possible from here.
That's right. That's
okay,
right.
Got that.
It all depends. Having said that, this is the initial part of the month,
yes,
and we are all banking on a good demand growth, and which we see because last year November was in any case a Diwali month. So we look at a double-digit growth this month in November as compared to last November on a year-on-year basis.
Okay, all right.
Double-digit growth. I just want to come back to that price increase you said of 7 to 8% in South and East. Mr. Kapoor, good morning, by the way. This is Sonia here. Can you tell us what is the cool off that you expect in the cost per ton? I think in Q2 you were sitting on at about 831 rupees per ton. How do you see it move, say, in the second half of the year?
At this point of time, we are all hoping that the fuel price increase, the costs will start showing a downward trend. Unfortunately, the numbers do not really say that. Like I normally try to, look at the cost in terms of what is the Reliance Petcoke price, because Reliance Petcoke is an Indian petcoke which benchmarks itself with the imported petcoke prices. And we have seen over the last 3 months that Reliance has been increasing their petcoke price every month. And it came down to 17,600 rupees per ton in September 22. And today it is sitting close to 21,000 rupees per ton. There is a reduction, I would say, as compared to the peaks. Let's say the US petcoke, which was getting imported at 25,000 rupees per ton, and I'm talking of landed prices in my plants, has now come down to about 20,000 rupees per ton. So I am expecting Q3 not much difference in price, especially as far as when I look at my company. We have some inventory which we are carrying forward. But Q4 onwards, I expect that the fuel prices should go down. But with what is happening in Russia, Ukraine, and other places, it's a little funny world at this point of time.
Right.
And any prediction that we do, we have to keep this point in mind that, geopolitical situations and the things happening across in the globe might impact the fuel price. So better is to be prepared and keep your belts tight for,
Indeed.
Unwanted kind of an or an unwelcome kind of cost increase.
Indeed, Mr. Kapoor, just to confirm though, you're saying that the relief comes in Q4 and we are talking about numbers as things stand. So we're not going to hold you for it if things change dramatically. But the EBITDA per ton could improve to what? To around 1,000 rupees, say, by Q4 or more than that, if you could give us a sense. And also volume guidance is 10%, right, for this year?
That's right. So volume guidance is 10% this year because it all depends, There are a few factors which might kick in. So as we start moving into the next year, we start coming within the hitting range of the next general elections. And we have generally seen that prior to that, a lot of projects which are already in progress, there is a tendency to, close them and start some new projects. I personally feel that EBITDA per ton guidance as compared to Q2, Q3 may not show much substantial increase, maybe 100, 150 rupees better than Q2. But Q4 onwards, as compared to Q2, I think we should see an EBITDA per ton increase of an industry average going to maybe by about 300 to 400 rupees. So maybe, 1,000 rupees as an average is likely in Q4.
Okay, so 1,000 rupees EBITDA per ton likely by Q4. Just a little more on a larger perspective, right? I mean, you briefly mentioned, Mr. Kapoor, that you're seeing a pickup in government projects, and that's been the feedback for a while. But I want to understand more about private capex, because we're seeing a big surge in real estate, a sector that you supply to. Infrastructure is coming back as well. CV makers are telling us that demand has surged. So where are you seeing the maximum amount of commitment in terms of money being put on board?
So at this point of time, you are right. It is private capex. We are seeing an uptake where government projects are also picking up. Rural, which was a little subdued till some time back, seems to be now just showing first signs of again getting back. I think the last, crops last season was okay from the rural perspective. We are expecting that in case a good MSP is given for the next crop, that will help us. But I think it's a mix of all. It's not just one sector which is primarily driving. Infra and private investments are leading it, but it's a mix of all. We even see IHB activities taking place across the hinterland of our country in all the other markets.
All right, Mr. Kapoor, on the EBITDA per ton, you're saying it could improve by 300 to 400 rupees for Q4. So in that case,
Q4 as compared to Q2.
So Q4 should be in the vicinity of around 1,200 rupees, and in Q3 it should be around 1,000 rupees.
No. So I don't think that's going to happen like that. Maybe, So something like so. Let's look at it like this. What I expect to happen in Q3 is a fuel price or a cost-led reduction of anything between 50 to 100 rupees, and a realization increase of anything between, again, 50 to 100 rupees. I'm talking of on an average for Q3.
Right.
In Q4, I expect another cost dimension coming in of close to 100 rupees or maybe around between 50 to 100 rupees. And price would all depend on what kind of demand comes. So that could surprise us positively. But I would say that Q4, the EBITDA per ton, we could look at as an industry maybe higher than 1,000 and Q3 lower than 1,000.
Okay. Are the shopping bags coming out, Mr. Kapoor? Any inorganic acquisitions that are on your plate right now?
See, we have just announced a 5.5 million ton expansion, and I think we are very happy with what we are doing at this point of time. Of course, as I always say, opportunities, if they come by and if they make sense for us in terms of our long-term business planning, we would certainly, go for it. But we are very mindful of the fact that we have to keep our debt under control.
So as of now,
we have
Mr. Kapoor,
Yes,
Kapoor,
please.
as of now, you're not shopping. That means you're focusing on, on what you have.
I'm giving a non-committal answer. I'm not committing.
Oh, that could be interesting then. Are you looking at a couple of assets?
No, nothing. So I don't want to talk of that. We are not looking at any assets per se. In any case, I, in my role as Chief Operating Officer, just operate the business, and our strategy team keeps looking at various options if there are any.
Okay. Generally, when denials mean denials, non-committal generally means that something is in the offing.
No. Let me not, help you in drawing that kind of a conclusion.
Sure.
Nothing as of now. You have seen that we have already committed
We take your word for it, sir.
of EBITDA, and
We take your word for it. We take your word for it.
We are looking at 25. So let me tell you, we are looking at 25 by 2025. So 25 million tons of capacity by 2025 in a healthy, profitable, growth-based manner, the way we have been doing for last 15, 20 quarters.
Got it.
All right, we will leave it at that. Great speaking to you. Thanks a lot for telling us about the environment, the cement industry, and of course your own business. Let's slip into a quick break. On the other side, Sanjeev Singhal of Mazgaon Dock Shipbuilders, a stock that has had a fabulous run, is going to join us in just a bit. We also have Jaideep Nandi of Bajaj Consumer Care, who will join in to discuss their Q2 earnings. Stay tuned for that.